Gross margin, gross profit, gross sales. Objectives: to study the function of gross margin, gross profit, and income statement. To solve some problems of gross margin, gross profit, and income statement. To cite some highlights, components of net income. Gross margin. Gross margin is a company business net sales revenue minus its cost of goods sold, or the COGS. In other words, it is the sales revenue a company retains after including the direct costs associated with producing the good it sells and the service it provides. The higher the gross margin, the more capital a company retains on each dollar of sales for any currency, which it can then use to pay other costs or satisfy debts obligation. The net sales figure is simply: number 1, gross revenue, followed by less the returns, allowances, and discount. Gross margin. It refers to the profitability measure that assesses whether or not a company is able to run its operation efficiently and generate enough profit. It determines the profitability after adjusting the cost of production that can be directly assigned to the manufacturing process. Highlight the components of net income. Separate expenses into cost of goods sold, operating and non-operating. May further divides operating expenses into selling expenses and administrative expenses. Operating results are reported as an income from operations. Add subtotals to increase usefulness of income statement. More complex formula. Net sales is equals to sales plus transportation in minus sales returns and allowances minus sales discount. Gross profit or gross margin is equals to net sales minus cost of goods sold. Operating income is equals to gross profit minus operating expenses and of operating revenues and expenses. Net income is equals to operating income plus non-operating revenues minus non-operating expenses minus income tax expense. Comprehensive income is equals to net income plus other comprehensive income minus other comprehensive expenses. Gross profit formula. Gross profit is equals to net sales minus cost of goods sold. This is an example of gross profit. Net income. Margega Company, 14 Lepo Street, Cebu City. It has a cell phone number of 0995-98943 or 987-453 as a cell phone number and telephone number. First, it has a revenue, 1,200,000 pesos. Then cost of goods sold is 95,000. So we will subtract 1,200,000 minus the cost of goods sold, which is 95,000, and therefore the gross profit is 1,105,000. Then after that, they will pay operating expenses. These are the commission and amount of 50,000, followed by marketing expenses, 10,500. Office expenses, an amount of 3,000. So if we will add 15,000, 10,500, and 8,000, then after that we will subtract again to 1,105,000. So the net income will be 1,071,500. Example of income statement. From LF Company income statement for the year ended December 31. Revenue. It has a net sales of $417,500. Gain on disposable of store equipment, an amount of 3,000. So if we will add the net sales and gain of disposal of stored equipment with a total revenue of $420,500, and they will pay the expenses cost of goods sold $210,000. Sales salary expense $38,000. Depreciation expense of the building is $40,000. Advertising expense $12,300. Office supplies expense is $3,500. Interest expense is $1,000. So if we will add this one, then the total is $304,800. Then after that, we will subtract $420,500 minus $304,800 as the total expenses of this one, and therefore the net income is $115,700. Problem number 3. Giatano Bookstore has a net sales of 20,458 pesos, and the cost of goods sold is 4,358 pesos. Therefore, how much is the net profit of Giatano Bookstore? The operating expenses account is 12,000. So what will be the solution? First, the net sales is 20,458 pesos. So, we will subtract the cost of goods sold 4,358 pesos. And the gross profit is 6,100. Then the operating expenses is 12,000. So 16,100 pesos. Subtract to the operating expenses an amount of 12,000. So the net profit is 4,100 pesos. What is profit? Profit is defined as the amount by which the sales are greater than the cost of goods sold and the other operating expenses. Profit can also mean as a gain or margin. In getting the profit, there are formulas to be followed. First, the gross sales minus refund and allowances is equals to net sales, while the gross profit minus operating expenses is equals to net profit. Formula for gross margin. Gross margin is equals to net sales minus cost of goods sold divided by net sales times 100%. The formula for gross margin is very simple. By dividing the difference between the net sales and the cost of goods sold, and divide by the net sales, and express in terms of percentage by multiplying with 100%. Other formula for gross margin. Gross margin is equals to revenue minus cost of goods sold divided by revenue times 100%. Revenue is the income or increase in net asset that an entity has from its normal activities, while commercial revenue may be also referred to as the sales or the turnover. Some companies receive revenue from interest, royalties, and other fees. Gross margin example. First, it has an income statement. So the revenue will be $700,000 and cost of goods sold is $200,000. Followed by the gross profit, we will subtract $700,000 minus $200,000 and the gross profit is $500,000. Then we will pay other expenses an amount of $400,000. Then we will subtract $500,000 minus $400,000 and it has a net income of $100,000. In order to get the gross margin, first, gross profit, which is the amount of $500,000 and the revenue is $700,000. So 500,000 divided by 700,000 times 100% is equals to 0.714234 or 71.42% as a percentage. Problem number 4. For gross sales. Gohon Company is a dealer of selling Narak furniture. It makes certain sales in January. It has a policy of giving a discount of 10% on the sales. If the payment made within 10 days of the date of the sale, the net sales for January are $95,000. Payment before the 10 days is made on 50% of gross sales. Calculate the number of gross sales. So this will be the solution. Let the total gross sales for January as a $100. This will be the assumption. If the payment on 50% on the gross sales is made before on the 10 days, then the gross sales whose payment is made early are $50 times 50% times $100. So, how do we get the discount? Discount is equals to 10% times $50. So 10% times $50 is $5. Net sales on which discount is given, 50 minus 5 or $50 minus $5 is equals to $45. So the total net sales amount in which discount is not given would be the same as the gross sales amount, which is $50. So total net sales of $50 divided by or plus $45 is equals to $95. Take note, total net sales is $50 plus $45 is equals to $95. So let's have continuation of problem number 4 of gross sales. Thus, assuming of gross sales of $100 and the net sales are $95, we have to calculate the gross sales on a given net sales of $95,000. So gross sales is $100. Gross sales with discount is $50. Gross sales without discount is $50. Discount will be 10. Discount will be 5. Net sales with discount is 45. Total net sales is 95. And the actual net sales is 95,000. And actual gross sales is 100,000. To get the actual gross sales is equals to 95,000 as our actual net sales times 100 as the gross sales divided by 95. So actual gross sales will be $100,000. Does the total gross sales are 100,000? Yes. Fixed expenses, fixed costs don't change based on production. Example of fixed costs include. So, fixed expenses are the rent, insurance, salaries of employees, payroll taxes and employee benefits, and property taxes. So, in every month, we will pay for the rent. We will pay for the insurance of our company. And monthly, we will pay for the salaries of employees. And we have also to pay the payroll taxes and employee benefits, like for example SSS, New Health, and Pag-ibig. And at the same time, we need to pay the property taxes that we will use, like for example building properties, lot properties, and others. Variable expense are the costs that can change based on how much you are producing. Sample of variable costs include material use. Why is it that variable costs are material use? We cannot say the amount of material used in our company to be used. Shipping costs, direct labor, credit card fees, sales staff, and agent commission. These are the example of variable costs. Sometimes it will change the amount of cost. It can be yearly, it can be monthly, and it depends upon the income of the company.